Russian companies are running into more delays and higher costs when paying trading partners in China. In recent months, deals worth billions of yen have not gone through. This started when Chinese banks began tightening up their rules because of warnings from Western countries about potential sanctions for doing business with Russia. Many Chinese banks have consequently stopped processing transactions with Russia altogether, causing big holdups. China is Russia's top trading partner, handling a third of Russia's foreign trade in 2023. It supplies Russia with essential industrial gear and everyday items that help Russia deal with Western sanctions. China also buys a lot from Russia, including oil, gas, and farm products. In June 2024, the U.S. Treasury warned Chinese banks they could face sanctions if they kept doing business with Russia. This has made Chinese banks very cautious, leading them to closely scrutinize transactions. Some Russian businesses are trying to get around these rules by using middlemen in other countries. This has made things even more expensive, raising costs by as much as 6%. The trouble with payments has started to affect trade. Between January and July 2024, Russian imports from China fell slightly to $62 billion. Russia's central bank also thinks that Russia's total imports might drop by up to 3% this year because of these payment problems. The Russian central bank recently stated that imports will likely decrease in 2024 due to tougher sanctions impacting payments and logistics. Kirill Babayev, head of the Chinese institution at the Russian Academy of Sciences, mentioned that without resolving these payment issues at the government level, it's tough to expect any new investments from China. Large companies in China and India, which depend heavily on American and European markets, are being warned that continuing to work with Russia could lead to being cut off from these major markets. This is like threatening to cut off their oxygen supply. As a result, China banks and financial institutions are facing the heat of secondary sanctions, which are causing significant disruptions for Russia. They're finding it hard to make or receive payments, which means that even if they strike trade deals with Chinese companies, they can't compete them if the money is not flowing. This is a big issue for Russia. Another problem arising from this situation is that Russian companies are running low on Chinese yuan. Since their Chinese partners don't want to be paid in rubles and prefer transactions in yen, the lack of this currency is becoming a real headache for Russian businesses trying to keep up with payments. Tighter U.S. sanctions have made it difficult for Russia to get Chinese yen, forcing local banks to borrow the currency at higher rates from the central bank. Since Russia was cut off from Western markets due to sanctions following the 2022 invasion of Ukraine, China has become Russia's main trading partner. Amid what has been called a no-limits friendship between Moscow and Beijing, around $240 billion worth of trade is now conducted almost entirely in yen. However, there is growing concern that Chinese banks may face penalties for indirectly supporting Russia's military actions through these financial interactions, especially under the latest U.S. sanctions expanded in June. The issue was a key topic during a recent meeting between Russia's President Vladimir Putin and the Chinese president. As yen availability in Russia dwindles, firms are increasingly resorting to yen swaps with the Bank of Russia, which was once considered a costly last resort. The average daily volume of yen borrowed through these swaps has doubled from 10 billion yen in June to 20 billion yen, about $2.8 billion in August. Sberbank, Russia's largest bank, does not see the situation improving anytime soon, according to Taras Skorskov, its senior vice president and head of the financial division. Russian economist Alex Isakov had noted that Russia's yen money market has not bounced back, indicating that Russian banks are struggling to find effective solutions. The Bank of Russia is now filling the gap possibly left by withdrawal of China's private bank branches from Russia. This increase in yen-based costs could lead to reduced trade volumes with China, Russia's primary source of imports. If China's exports to Russia, whether directly or transshipped, decline in the latter half of the year, Washington could see this as a significant victory in its sanction strategy. It also raises questions about the yen's potential to be a possible alternative to the dollar in global trade. Due to the challenges Chinese banks are facing, there is now a shortage of Chinese yen available to Russian companies. To manage this, they're increasingly turning to swap deals with the Bank of Russia to secure the necessary currency. These swap deals have seen significant fluctuations throughout 2024. In the early months of the year, the volume of these swaps was relatively modest. January saw about 2.4 billion yen in swaps, with a slight increase to 3.5 billion in February. March experienced a peak of 5.2 billion yen, but then the numbers dipped significantly to just 1.6 billion in April and slightly rose to 1.7 billion in May. However, a notable shift occurred in June right after the U.S. intensified secondary sanctions and issued strong warnings to Chinese banks about their dealings. These warnings led to a sharp increase in swap volumes to 10.3 billion yen. The trend continued upward, with July recording 6.5 billion yen in swaps. By August, the volume had more than tripled from June's figures, reaching over 20 billion yen. This dramatic rise in August alone was almost equal to the total of the previous 6 months combined. This surge illustrates the severe currency shortage Russian companies are facing as they struggle to gather enough yen to meet their payment obligations. The escalating need for yen through swap deals shows the growing financial pressures on Russian businesses due to tightened international sanctions and banking restrictions. These financial problems are making it increasingly difficult for Russia to sustain its trade activities and financial commitments, particularly with China, its major trading partner. Since March 24th, the cost of borrowing Chinese yen in Russia has seen a significant increase, reflecting the growing economic pressure on Russian companies. Initially, the swap rate set by the Russian central bank was at 4.2%, but by the end of August, it had risen to 7.3%. Similarly, the overnight rate for borrowing yen started at 5.8% and climbed to 7.5% within the same time frame. However, these rates have experienced some dramatic spikes due to acute shortages of the yuan. For example, in June, the rate surged to an alarming 27%, and in early August, it again rose sharply, reaching over 20%. These spikes are clear indicators of the severe liquidity crises that occur when the currency is in extreme shortage. As the availability of the yen continues to tighten due to sanctions and cautions by the Chinese banks, Russian companies are facing higher expenses just to secure the necessary currency for trade and transactions. While this situation complicates their business operations, it also adds a significant financial burden, affecting their overall economic stability and capacity to engage in international trade effectively. U.S. sanctions have created significant payment problems between Russia and China, seriously affecting Russian imports of Chinese cars that have dominated the domestic market over the last 2 years. Alexei Podchakoldin, president of the Association of Russian Automobile Dealers, highlighted that this issue is especially critical for smaller importers who have experienced bounced payments. As a result, China is seeing fewer exports, while Russia importers are losing business and potentially facing additional costs. Even if a Russian bank operates in China and manages ruble accounts, transactions with China are becoming impossible to execute. Previously, major Russian and Chinese banks handled these transactions, but sanctions have gradually targeted these institutions, pushing businesses to smaller second- and third-tier banks. Since Western car manufacturers withdrew from Russia, taking their technology and know-how with them, Chinese car makers have captured more than half of Russia's car market. From January to May 2024, China's car exports to Russia increased by 36% in monetary terms, reaching $4.86 billion, according to Chinese customs statistics. The situation is so severe that even larger domestic producers who need to buy spare parts are struggling with these payment issues. To overcome these challenges, the idea of barter trading, which is exchanging equipment directly for other equipment, has been suggested. However, this approach faces practical difficulties as authorities would need to establish agreed prices for the car and spare parts, which is more complex than trading basic raw materials. Bartering might work for commodities like oil, wheat, sugar, and gas, where it's easier to agree on values, but for cars, it's a different story. It is extremely challenging to set equivalent values for vehicles and parts, making barter nearly impossible for these items. Nornickel, the world's top producer of refined nickel and palladium, recently announced a drop in profits, blaming it largely on payment troubles due to US sanctions. These sanctions, implemented in June to limit Moscow's actions in Ukraine, have made it risky for banks in countries that do business with Russia, like China and Turkey, to handle money transfers without facing penalties. This situation is causing big headaches, especially with China, Russia's key economic partner since the conflict started. The sanctions are hitting Nornickel hard. The US has targeted several of the company's associated service providers, including those supplying fuel and IT services and even an airline. The Bystrinsky copper mine, started by Nornickel in 2017 to serve the Chinese market, has also felt the sting of these sanctions. Interestingly, while these affiliates have faced penalties, Nornickel itself has not been directly sanctioned by the US or the EU. Financially, the first half of the year was not great for Nornickel. Their revenue was down 22% from last year, landing at $5.6 billion. This decline was driven by dropping metal prices and logistical problems that have disrupted their supply chain and affected sales. Their earnings before interest, taxes, depreciation, and amortization fell by 30% to $2.35 billion. Free cash flow, which is the cash a company generates after accounting for cash outflows of support operations and maintain its capital assets, also took a major hit, dropping more than 60% to $525 million. Nornickel's working capital also jumped by 20% to $3.7 billion, mainly because they're sitting on a lot of unsold stock. This stockpile likely grew because it has become harder to sell and ship their products, especially to major markets like Asia, where they usually send over half of their output mainly to China. While the sanctions have affected the financial aspects of Nornickel, they have also caused challenges in maintaining operational efficiencies and capital expenditure. The difficulties in cross-border payments have forced the company to re-evaluate its investment strategies and delay or cancel some of its upcoming projects, which could have further long-term impacts on its growth and profitability. With the ongoing sanctions and payment issues, maintaining these important trade ties is more challenging than ever, directly impacting their bottom line. The ability of Nornickel to navigate through these troubled waters will be very important for its future, particularly as it looks to sustain operations and retain its position in the global market amidst growing economic pressures.